For more on rates and the markets, let's bring in market forecaster Jim Bianco, Bianco Research. Jim, great to have you with us. He warned, by the way, on Fast Money earlier this month that bond yields could race through 5% in the next couple of weeks. Now believes they can go even higher despite today's reversal. How high are we talking about, Jim?
Well, if the yield curve is going to uninvert, and that seems to be what it's doing, and that means that the highest point in the yield curve will eventually become long-term interest rates, which is normal. Well, the highest point in the yield curve right now is 6-month bills at 5.5%. So if we're going to completely uninvert the yield curve, and I think we're destined on to do that or somewhere along those lines, then it's got to go to at least 5.5% because the Fed has said that they're higher for longer. So I don't think that this move is quite over with just yet. I know everybody keeps asking me when the move is going to be over with, but I think that the problem that everybody faces is they forgot that 2009 to 2020 was the QE period. That was abnormal. They look at zero rates. They say, my God, we've come up 500 basis points. That's a lot. That's going to hurt things. No, the first several hundred of that was just getting back to some level of neutral. The last little bit of it has been restrictive. I don't think it's been restrictive enough to really hurt the economy. That's why later this week we're going to probably report a 4% GDP after we had some pretty good numbers in jobs and with unemployment claims going under 200,000. So we're not really punishing the economy, and that's why I think these markets have room for rates to continue to move higher.
And laying out the case to 5.5%, Jim, you didn't mention Treasury issuance, and you didn't mention the Bank of Japan, and I'm wondering how those two factors factor into 5.5%.
Well, they don't help the situation that, Treasury issuance is going to be more of a shift from short-term to long-term. So it's not that we're going to be issuing more than what we've expected. It's that we've issued a lot of Treasury bills after the debt ceiling was lifted. That was 4 or 5 months ago. Now they're maturing, and the Treasury wants to kind of issue more 3-year, 5-year, 10-year notes. And so that's going to help put upward pressure on long rates. The Bank of Japan, remember now, Japanese are the largest foreign holder of Treasury securities in the world, not China. So if they are going to loosen up and let their rates go up, Japanese investors are going to say, you know what, our own JGBs, their Japanese government bonds, look more attractive. Those sell Treasuries, they'll move back to Japan, and then we're going to see a dampening of demand from one of the largest buyers of Treasuries in the world.
Hey, Jim, Tim, yeah, I agree with that. But great call a couple weeks ago on our show. It was probably 3 weeks ago. You said they're going higher. They've gone higher. You also have pointed out that you think it's not just Japanese institutional buyers or even the Bank of Japan. It's that a lot of investors were on board with this recession argument and that a lot of people have actually capitulated. That's the term I think I've heard you use. Talk to me about that. Where do you think positioning is now? Because it seems to me like everybody thinks yields are going higher, even though, it's a conversation you were having a few weeks ago. And certainly a couple months ago, this isn't where people were. They weren't talking about 4% GDP. How much of this in the institutional and in the retail world is something that you think actually might be why we could get more of a pause right now?
Well, yeah, I think that, the problem with positioning is there's fin-twit talk and there's what people say and everybody says it's going to go higher. Then if you look at the way that people are positioned, I like to joke that they're up at night staring at the ceiling going, my God, there's going to be a big bond rally without me. And that's why you see this relentless flow in the TLT. And that's why you see this relentless amount of call buying in TLT. In the last month, there's been 1.5 million calls purchased in TLT and something like 400,000 puts. That's why you continue to see surveys like the Bank of America Global Fund Manager Survey having the highest amount of people in the 20-year history saying the next 100 basis point move is going to be lower. So that's why I say there's got to be some kind of capitulation. Everybody is waiting, begging. They're trying to position for this big decline in interest rates, and it doesn't happen, and they keep getting punished while they're waiting for it. And we all know the way markets work is when it happens is when no one's positioned for it. And so I still think that there's got to be some more capitulation in this bond market, which is why I don't think this move is over. Now, maybe for the next couple of weeks, we churn sideways around 5%, but ultimately I still think we're going to go higher and see a capitulation.